All right, everyone. Thanks so much for waiting. Just wanted to make sure that enough people had come into the meeting here, so we can get started. Today I'll be talking about whether your mortgage is tax deductible, how you can make it tax deductible, and what to do to properly structure your residence to invest as well. So let's talk about a few things that we'll be talking about today. I'll be talking about how to use your home equity in your home. What is a HELOC, a home equity line of credit? What is good debt versus bad debt? Talk about the tax savings and also investing in real estate. And then a couple of different categories. So investing in private lending, what are called exempt market dealers, investing in stocks, and then comparing all of the different options that you could have. We're finding that right now, a lot of clients are starting to get a little bit more active now that there's seemingly some light at the end of the tunnel. Obviously, rates haven't started to come down just yet, but the expectation is that they will during 2024. And so we're finding that more people are starting to get prepared for when that does happen and wanting to be able to take action as interest rates start to decrease. So the first off, let's talk about using your home equity and what you should be considering. If you're paying off your home and getting rid of that, of course, it's great that you pay off the mortgage, but a home that's paid off is not really working for you because other than the appreciation, there isn't really any gain to paying off your residence. And so I think that was very common when people bought their homes, a number of years ago. They think, okay, I'm going to buy a home, pay it off, and then that's my retirement fund, and I'm good. Now it seems, especially in certain areas like Vancouver and Toronto, it just seems very, very difficult and rather expensive to work on paying off your home, especially considering homes are worth $2 or $3 million, and more people are left with reverse mortgages, as an example. Less people are able to actually get rid of that mortgage before they retire. In fact, one thing that I've noticed is that year over year, for the last 3 or 4 years in a row, reverse mortgages are up by about 30% per year. So it's a very large increase in reverse mortgage applications coming through. And I think that's partly just due to the fact that real estate's becoming more expensive, less people are paying off their home, entering into retirement. So one of the things that we want to look at is, you could pay off your home, and that's one way of growing your wealth, but it's not the only way of growing your wealth. There's a number of different ways that you can do so. And one of the things that people are often faced with is, do I increase my investments and increase my stock holdings and other investments, or do I pay down my mortgage? And that's a tricky situation. Which one should I do? My investments are earning me 8% and my mortgage is at 6%. So what should I do? And often the recommendation is actually not to choose between one or the other, but to do both at the same time. And so the question is, how do you do this at the same time? And the reality is it really comes down to getting a home equity line of credit. And so what you want to be looking at is a product that is what's called readvanceable. So readvanceable just means that as you pay down your mortgage, your line of credit limit will automatically increase. Now, the government changed some rules last year, and you can only readvance up to 65% of the value of the property. So that means that you can still borrow up to 80% of the value of the property between mortgage and line of credit. But as you pay down the mortgage, the line of credit limit won't increase unless you've paid down the mortgage below 65% of the overall value of the home. And so that's something to consider, is that, depending on the value of your home, you might not be able to get dollar for dollar increase to the line of credit as you pay down the mortgage until you've reached that 65% threshold and paid that down further. But the idea here now is that you can pay off your mortgage, and every dollar you use to pay off the mortgage, the line of credit limit will slowly increase. So in this example here, what we're looking at is if your home was worth, let's say, $500,000, you can get up to 80% financing, so up to $400,000 in total. And let's say that the borrower owes a $225,000 mortgage currently, then you could have that portion as a mortgage and then a 175 line of credit component. So the two combined equals 80% financing. And then what you do is, as you pay down the mortgage, your line of credit limit is slowly going to increase. And so over time, this line of credit limit will increase as you pay down the mortgage, because you can always borrow up to $400,000 on the facility. And then what you actually do is you borrow the money out of the line of credit to then invest. And this is a really important key, because whenever you borrow money to invest, the interest portion of the payments is tax deductible. I always say that you should talk to an accountant to make sure that whatever you're investing in is tax deductible. In general, the language that I understand is that you must be borrowing money to invest into something that has the opportunity to earn an income. So you do need to make sure you speak with your accountant about the eligibility of certain assets and in certain investments. However, our understanding is that if you're investing into something that has an opportunity to earn an income, then you should be able to write off the interest portion of the payments. So this is the core strategy. And in fact, we do have some examples of clients that come to us and say, hey, Kyle, I've got $100,000 of cash that I want to invest into an investment. What should I do? And the recommendation often is, well, if you took the cash and then just use that for down payment on an investment property, you don't get any tax deduction or write-off when you do that. But if you took the $100,000, paid down your non-tax deductible mortgage, and then reborrowed the 100 grand back out, and then use that to invest, now you can show and prove a paper trail that shows that you've borrowed the money to invest, and that money would be tax deductible in that scenario. So this is something that you'd want to think about and keep in mind. And sometimes it's just a very simple change in the structure of your home mortgage in order to be able to be tax deductible. And so just make sure that you're tracking this. If you don't properly track it, it's very hard for you to be able to know how much of your mortgage is tax deductible and how much you can write off. So it's really important that you actually ensure that you're tracking this and confirming these details. And yes, Ellie, this is being recorded, so I will be sending out to all of the people that has registered for the event. We'll get a copy of this after the event. So one other thing I want to talk about is good debt versus bad debt, because there is a difference. And your objective is to minimize bad debt while utilizing or using, but not abusing, good debt. So bad debt would be borrowing money to buy depreciating assets. Consumer goods would be a great example of this. Many cars would be an example of this. Obviously there are there's always circumstances and exceptions, like buying classic cars that are going up in value and whatnot. But for the most part, bad debt is when you borrow money to buy something that's going down in value. And the reason for that is that you're paying interest on borrowing the money, and then the value of the asset's also decreasing. So you're getting hit on both the interest and the depreciation of the asset. And that's why it's considered bad debt. Good debt, on the other hand, would be borrowing money to buy appreciating assets. And so the borrowing money to buy real estate or stocks or something like that, where yes, you have an interest cost, but you're offsetting the interest cost with additional gains in the asset value over time. And then, of course, the best is tax deductible debt. And so that would be buying appreciating assets and being able to write off the interest portion of the payments, which in most cases, when you are borrowing money to purchase assets like real estate, stocks, etc., you can often write off the interest portion of your payments. And so that's really what you're looking to do here, is try to make sure that you're not borrowing money and going into bad debt. You're trying to make sure that you're going into good debt. And the reality and the key here is that net worth is your goal. You're looking at, the assets minus the liabilities equals your net worth. And so if you're borrowing money to buy vehicles, maybe not a great option. If you're using credit cards and buying consumer goods, maybe not a great option. But if you're buying real estate, real estate is one of those assets that tends to appreciate over time, and is obviously the main purpose and focus of our presentation today. And so it's really important that when you're structuring the mortgage, you need to make sure that you're doing this in a way to save tax. And so, we have to look at, how does this work? Making sure that the structure that you use is going to be sufficient. And basically, you're trying to make sure that you're making your mortgage payments. By doing so, you're able to reborrow the principal that you've paid down. Then you're investing the money that you have available to you in your line of credit, and then you're saving money on taxes because you're borrowing money to invest. And I do want to again reiterate that the use of funds is really relevant here. They do look at things like if you're consuming whatever you're purchasing, then that's not considered tax deductible. And if there's an expectation of generating income, then that generally is tax deductible. And again, I'm not an accountant, and so I always recommend speak with an accountant to make sure that whatever you are borrowing money to invest in is actually something that would be considered tax deductible. Now, one of the things that is often the structure, and I will say that as interest rates have risen, we've seen less people do this over the last year and a half or so, except in very certain circumstances, and I'll get to those in a moment. But one of the things that people often do is they just try to borrow money against their line of credit or against their mortgage and then invest it, and just find an opportunity where there's an investment that can make a high enough rate of return that could offset the cost of borrowing. Now, back just 2 years ago, when line of credit rates were about 2.95%, it's pretty easy to find an investment vehicle that could earn at least 6%. And actually, that's one of the issues that we found and what caused inflation was that cost of borrowing is so low and the opportunity to make money is so high that people were borrowing lots of money and using that to invest. And it caused a lot of additional credit and a lot of money to flood the marketplace. Now, of course, things are tightened up and it's harder to know exactly where the markets are heading, especially in stocks, et cetera. And so borrowing money to invest is a little bit more difficult, especially when you're borrowing at prime plus 0.5, which is kind of a standard interest rate on a line of credit, which would cost you about 7.7%. And then investing that, and to create a meaningful enough spread, you probably want to make at least 3% more than your cost of borrowing. And so you'd have to find an investment vehicle that could get you at least 10.7 or 10.75% in order to offset that cost. So that's the tricky part, of course, is finding, okay, now that interest rates have risen, is there an investment that could make enough of a return that would make sense to me? And so that question of, well, what do you invest in? What are some of the investment classes and opportunities that you can borrow money to invest in a climate like this? And there's a number of different options that you can look at. Investing in real estate, of course, is one of the popular ones, especially in Canada here, as real estate values have continued to increase and are still slated to increase even in 2024 and 2025. And ideally, trying to buy cash flow rental properties is the objective. And you don't necessarily have to. You can buy, properties that are going to have capital appreciation. So something that might be a land assembly or something close to a SkyTrain or LRT or something like that. But that's something to look at. Investing in stocks, that's of course a very popular option too. Investing in growing companies, something where the value of the stock will go up, and of course, ideally, if it's returning some kind of dividend. And there's other investments as well. So there's private lending and private equities. Both of them have the word private in front of them, but they're very different things. But there are other investment vehicles that you can look at as well. So really quickly, let me talk about why invest in real estate. And that's one of the things that I'm sure many of you are here for to learn about. But the leverage aspect is one of the most important things to look at. So leverage is a major key, especially because you can buy with as little as 5% down for owner-occupied and second homes, and the minimum down payment for rental properties is 20% down. And that means that when you're looking at the returns in investing in real estate, it's not just the leverage aspect, but it's a couple of different things. So first of all, let's talk about the cash flow. Cash flow in general, you're looking at about, well, even in today, I would say it might even be negative on the cash flow for many investments. Historically, cash flow often is anywhere from 0 to 4%. So a lot of the time in the past, if you found something with 20% down payment that just covered its expenses, that's often pretty good. But of course, that's tricky now. In fact, many investments right now are cash flow negative because interest rates are quite high and values haven't really come down enough to offset that. On the appreciation side, one really important thing here is if you put 20% down payment, that means for every 1% of appreciation, your return on investment is 5%. And the way that works is if you bought a property that was $500,000 and you put $100,000 down, so 20%, and the property value went up by, let's say, 10%. So it went from 500,000 to 550. That means you've made $50,000 on your investment of $100,000. So even though the value of the property went up 10% from 500 to 550, if you make $50,000 on your $100,000 investment, you've made 50%. And so the returns are basically multiplied because it's always looking at the amount of capital you put into the deal, not the total value of the asset. And so if you put 20% down, and we assume about an annual appreciation rate of, let's say, 3%, which is usually what I use for my models, then your return on investment from appreciation would be 15%. And of course, you're going to have some years that are way higher than this and some years that are lower than this or flat. But at the end of the day, over a long period of time, it's reasonable to expect that real estate will appreciate at about 3% per year for long periods of time. In many major urban centers in Canada, it's been much more than that. But at the end of the day, I like to be relatively conservative with that figure. But that gives us a 15% return on investment from the appreciation. And then you have the mortgage pay down. And having a tenant pay down your mortgage for you, depending on the mortgage rate and terms that you have, if you had no cash flow, and even if the property didn't appreciate at all, just having a tenant cover your mortgage payments for you and paying down your mortgage for every single month would represent about a 5.5 to 7% return on your investment every single month. And so that, or every single year. So that means that if you bought a $500,000 property, got a $400,000 mortgage on it, which means you put $100,000 down, the tenant's probably paying down about $5,500 to $7,000 per year on your mortgage on your behalf. And that's something that people don't often think about. Focus a lot on cash flow and often focus on the capital appreciation, but we tend to forget about the mortgage pay down. And in many cases, if you were just to put your money into some kind of mutual fund, you're probably getting between 4 to 8% return on your mutual fund. And so all of a sudden this mortgage pay down is right there, but you also have the ability to get cash flow in the future and the ability to get appreciation on the asset too. Now you add this all up, this number seems really high to me. But the reality is when you add up cash flow, mortgage pay down, and appreciation, the returns on investing in real estate are often 20 to 26%. I will say the deals that I'm looking at right now, because a lot of properties are actually cash flow negative, not positive, and the mortgage pay down, depending on the exact rate that you're getting, might be even slightly lower than this. Some of the deals that I'm looking at can be anywhere from 12 to 16% return. Some of them are 18% return. It really depends on the nature of the deal. And so we're seeing that with the inflation and high interest rates, it is negatively impacting the returns in investing in real estate. But anything in the mid-teens still seems pretty good when you're comparing it to other investment classes. One thing I do want to touch on, because this has been very common and very popular, we've seen a lot more demand and a lot more supply for private lending. But private lending is basically becoming the bank. And so instead of borrowing money from people, you're actually lending money to individuals, and you're often using a line of credit to do so. And you're lending to individuals who couldn't get a mortgage through the bank for a number of different reasons. And so their interest rates are typically a fair bit higher. Some examples of deals that you might do as a private lender could be lending somebody the money that they need for a deposit on a real estate purchase. It could be helping somebody do a flip. It could be helping somebody do some kind of development deal. Often just a standard first or second mortgage is very common as well, if there's a reason that the borrower can't qualify for a standard mortgage. And just in general, private loans tend to be shorter term loans. Usually the term is about 1 year in most cases, and so those 1 year terms, they're hoping that you have the ability to pay them out within 1 year, so that that you can get out of that and get into a regular mortgage or sell the property or whatever. And it also just reduces the borrower or the lender's risk when they're lending on a property if the borrower has an exit strategy to get out of it. Now, another thing I want to talk about really, really briefly is private equities or exempt market dealers. And so what some people do is they find, well, I'd love to be investing in an apartment building, but I don't have the kind of capital necessary for that. And I've actually seen that CMHC, so that's the Crown Corporation that insures a lot of mortgages in Canada. They've also been very heavily involved in the multifamily side of things. And so they've actually been highly incentivizing investors to build multifamily properties. So that would be anything that's 5 and more units. And they're offering, in some cases, up to 50-year amortizations, up to 95% financing. And so the financing terms can be very, very attractive in those cases. And the rates are actually lower than residential rates. So you can get better terms on that side, but you usually can't get those terms on, a 5-unit building. It usually has to be a 50-unit building or a 75-unit building. And that can be a lot harder for a mom and pop investor to qualify for. And so the way that private equity works is those companies go out, collect money from a number of different people, and then collectively get those individuals grouped together to then help you invest. So effectively, the pros are that it's passive, it's a hands-off way of investing because you're not the one having to find the deal, they find the deal for you. You're not the one getting the mortgage. There's a much smaller minimum investment. You can diversify in many different assets with smaller amounts, and in many cases they can be RSP and TFSA eligible. And the cons is that these investments are a little bit less liquid. You have a little less control. They can take longer to exit, and in some cases they can be considered higher risk depending on the nature of the deal. So there can be some pros and cons to that, but it is something to think about. And when private equity isn't just for people that are in blue and black suits, it's open to basically anybody and everybody, and it's designed to provide a passive, hands-off way of investing in real estate. So if anybody wants to learn more about that, I do have some contacts that focus on the private equity side of things. and they usually are more real estate focused. But there are also other investments that they'll do. Some of them have stock investments. Some of them have different routes and opportunities that are available. So something that you can always learn more about. Now, of course, you could also invest in stocks if you want. Let's take a look at a stock investor here. Oop. I clicked a couple too many buttons here. 1 second. Okay. There we go. So you can invest in stocks. And this is what stock traders like to see. So, looking at the screens, not having a very good time. This guy's definitely not having a good time. Rough day in the stock market. That guy wants some money, though. Every once in a while, you do well. This person also not having a good day at the office. Or you can invest in real estate, sit back, relax, and watch your investments grow. Now, yes, this is a very fuzzy picture. I actually first used this back in, I want to say 2012 or 2013, something like that. But I really love the photo. Can't stop using it. So my apologies in using such grainy photo for my presentation, but I just love it. Anyways, I hate the fact that I clicked the button too many times and I totally whiffed on my delivery of that joke. But anyways, so how do you choose between the different investments? I do have a quick chart. I won't go through this in a ton of detail, so I'll kind of skim it. But at the end of the day, the returns on investment in investing in these different asset classes do tend to vary. The payment, how you get paid out, how what the term of the investment is, the volatility, the liquidity, and whether they're RSP eligible. Here's a bunch of information that you can take a look at, and if you ever want to, you can take a snapshot of this photo. Obviously, none of the returns are ever guaranteed. This is just a kind of a rough framework. I would probably say that this slide was done a little while ago, where the average total return on investment investing in real estate was more like 20 or 30. I'd probably actually inch that down to maybe 14 to 20 as of today. Private lending is probably even a little bit higher. Most of the private lending deals that we're doing today are about 9% to 14%. And one of the reasons for that is that as interest rates go up, the private lending rates also go up, because usually most private lenders are pricing their deals at prime plus something. And so you'll find that most of the deals in private lending are prime plus 3 to prime plus 4, depending on the nature of the deal. And so you'll find that the total return on investment investing in private lending tends to be higher. And obviously stocks, who knows? I mean, when I say 5 to 10%, I'm kind of referencing investing in a mutual fund of some sort, as opposed to picking the hot items and crushing it. So if anybody has any questions about this, or if you want that specific slide, I'm happy to send it out later. But this is just a quick run through on the different opportunities, and they all have different pros and cons, to be frank. Now, all that being said, it's really important to diversify. You shouldn't be putting all of your money into real estate, no matter what. Even if you think that real estate is the way to go, you should have some liquidity. You should have some diversification, and so that's something that's really important. A couple of things that we would be, our clients are doing right now are they're reducing their payments and paying off high interest debts by refinancing. Especially if you're carrying any high interest debt like credit cards, lines of credit, that kind of stuff. You should be trying to pay those off and eliminate that. Learning how to properly structure your mortgage to save money in tax with some very simple changes, that's important too. A lot of our clients are getting capital available to invest, and I think that at the end of the day, this market's very interesting. We're not really sure what's going to happen in the next couple of months. I will say that the last 2 months, the market has picked up in a very big way, maybe in the last month and a half, I would say, to be more accurate. And we're suspecting that as the Bank of Canada starts to drop interest rates, we'll start to see a lot more people entering the marketplace again, and the market may start to have a little bit of a hot streak. And we don't know how long that hot streak will be. But at the end of the day, I do think that this might be, for the next couple of months, one of the better opportunities for the next couple of years to be able to pick up a property and be able to negotiate with maybe just the seller, instead of you and 5 other people having to jump over each other in order to get involved. So that's something to take a look at. And getting a line of credit and having access to it doesn't mean that you have to actually use it. You can always just get access to it and then not utilize it. And then one thing that I am seeing some of our clients doing again, and frankly, it has been some time since people have been super active in this, is utilizing their home equity to start to look at buying investment properties again. Jacob, the question regarding what's RSP eligible, that would be investing in private equities. So using an exempt market dealer who is able to then place your funds into different private equities. So that's something that is RSP eligible. Also, being a private lender is also RSP eligible. So you can self-direct your own RSPs and then be a lender, and you can lend out your RSPs as a private lender. So I think it's time to get your retirement strategy in place and figure out where you want to be. Paying off your home is of course an option in order to reach retirement, but I think there are better options to consider. The key here is really understanding if your mortgage is tax deductible. I think that's the most important thing. We do have on our website, we have things that you can look at. So we have upcoming webinars. We have an investor survivor guide. We have a private lending package if you want to learn more about that. You can always book a consult with us as well if you wanted to learn more about anything that we've talked about today. I do, by the way, have some extra books in my office about whether your mortgage is tax deductible or not. I think I only have 2 or 3 left. And so if anybody does want one, just send us an email at info@greenmortgageteam.ca and we'll pop one in the mail and send it over to you if you want to learn more. And of course, if you don't have this awesome book by this awesome author, Rockstar Real Estate Investing, it's the book that I wrote about investing in real estate. And it's really good to just kind of lay the foundation for a lot of the things that we talked about today. Thank you, Ellie. So yeah, it's a great book to read just to learn a little bit more about investing in real estate. And if you have any questions, feel free to contact us. I do have some questions that are in the Q&A, so I'll start to answer those. And please feel free to put in any questions you have in the Q&A, and I'll do my best to answer everything before we wrap up. So Justin has a question: how difficult is it to get a line of credit on an existing rental property? So it's actually not that difficult. A number of lenders will offer lines of credit on rental properties. It is more difficult, however, if the rental property is owned in a holding company, it is harder to do that. So if you're trying to get a line of credit on a property in a holdco or an opco, for that matter, it's much more difficult. So it's easier if it's just owned in a personal name. The major issue with getting a line of credit typically is the qualifications are much higher or harder than a standard mortgage, actually. So people, for some reason, figure that a line of credit is easier. It's actually not, because when you get the line of credit, they have to assume that you're going to borrow the entire limit of the line of credit, and they have to use the line of credit rate. And a line of credit rate is higher than a mortgage rate, so they base it off of prime plus 0.5, and then they have to stress test that. So the rate that they use to qualify a line of credit is very, very steep. So it can be more difficult for you to qualify for a line of credit in a standard way. The question with Penny is, what banks have HELOCs? Basically, every bank has a HELOC. Now, some products are better than others. Some lines of credit are static, which means you get a mortgage and then you get a line of credit. And then as you paid in the mortgage, the line of credit limit does not change or increase. Some lenders have products where as you paid in the mortgage, the line of credit limit does increase. And so what we talked about today was ideally getting one of those that is readvanceable, which means that as you paid in the mortgage, the line of credit limit does increase. Those are usually the better products. However, in some cases, it can make sense to go with a lender that has a mortgage and a line of credit that is static. And the reason for that is that sometimes they just have a better rate available for the mortgage. And maybe you don't really care or need to get access to that little bit of principal reduction that you're paying down on the mortgage. Especially if you have a very small personal mortgage right now, you probably won't get a lot of value out of, let's say you have a $100,000 mortgage right now. You're probably only paying down a couple $1,000s a year based on a 30-year amortization, so it wouldn't really matter. But every bank has a line of credit of some sort. We find a lot of lenders don't have it. Is in the broker channel, there's a lot of non-bank lenders that we deal with that have very good rates, but they don't always have line of credit products. And so that would be something that would be a little bit different. Devin has a question. So purchasing a new property, how much income per 100 grand of real estate is required typically? So the math is that if you have no other debts, you need about $25,000 of income per $100,000 you're borrowing. So a couple of years ago, when the interest rates were lower and therefore the stress test was lower, that math was actually about $20,000 per 100 grand required. Now you need about $25,000 of income per 100 grand. Now, in some cases, if you're putting 20% down and using lenders that can stretch things a little bit, so some of the banks sometimes can stretch the debt servicing limits a little bit, you might find that maybe that number ends up being 22 or 23 grand per 100, but in general, you need about $25,000 per 100 grand that you're borrowing. And there are some circumstances that you can get away with less. The only other thing is with people with high incomes borrowing a lot, it's not quite 25 per 100 grand because you're stretching the property taxes, strata fees, things like that over a much larger amount of income. A $2 million home versus a $500,000 condo, the $2 million home is not necessarily going to have property taxes and strata fees that are 4 times more than the condo would in that case, as an example. Awesome. Does anybody else have any questions? You guys are taking it easy on me. No other questions. I'll tell you what, if you do have further questions, I know we went through this fairly quickly, but if you have any other questions, let me know. You will get a copy of the recording, and we always put this up on YouTube as well. If anything else comes up, feel free to send it over to me. Eric, are any clients building ADUs? What is an ADU, Eric? Oh, garden suites. Yeah, so I know that the government made a change where they're allowing you to get a 40, up to $40,000 to help support building an additional, yeah, thank you, additional dwelling unit. We're finding that some people, of course, are doing this. It's not as frequent as I would have expected. I thought we would have a lot more people trying to refinance in order to build additional rental suites in their home. It has not been super popular, but I expect that it will be more popularly moving forward, especially as interest rates start to decrease a little bit. I think we'll still start to see that a bit more. But as of now, not a whole lot, and I'm a little bit surprised we don't see more of it, to be honest. One more question. So William's asking, can we use the Smith maneuver on primary residence mortgage when investing with partners? So just so everybody understands, the Smith maneuver, that's the book that I had showed you guys. The terminology that's used a lot of the time when talking about the tax deductibility is based on something called the Smith maneuver, was a book that was written not too long ago that talked about this strategy and kind of popularized it. So using this tax efficient strategy in a primary residence when investing with partners. So typically, yes, you could still use it with investing with partners. Sometimes when investing with partners, you're actually buying a property in a company name, and then things get a little bit more complicated because you have to have a mechanism in which you're getting the money from you personally to a company, and those are 2 separate entities. And so that's something that you need to look into. But there are ways that generally you can be lending the money to your company, and the company may need to be paying back you as an individual in order for you to be able to claim a tax deduction. So there's some complications in some cases, but as a general rule of thumb, you can do it. It's just a matter of the mechanism and how, and that would be something to talk to your accountant about. And yeah, thanks, Eric. I agree. I think that would be something that people would want to learn more about, is how you can do that. Because if it costs, let's say, $50,000 to put a suite in your home, the cost of borrowing $50,000 is only about $300 a month, but that might be able to increase your income on your property by $1,200 a month or more, depending where you are. And so that's an interesting thing to look at, is, hey, if a home that's easily suitable, it might not cost you a lot of money to increase your income, and you'd be able to increase your income by a lot more than the cost of borrowing the money to do those renovations. So it's an interesting point to look at. Gavin has a question. If you use your HELOC to make your down payment, can you deduct the interest? So yes, that's how most people would do it. Most people use the HELOC for the down payment on an investment property. It's just that the very important key is you have to be showing that you're borrowing it for investment purposes. If you borrowed the down payment for a second home or another primary residence, then that's not tax deductible. If you're borrowing it to purchase an investment property, then it would be tax deductible. And this sometimes comes up where people are borrowing money against a rental to use for down payment on an owner-occupied home. That money would not be tax deductible because the purpose of the funds was to be used towards purchasing your own home, and that mortgage and that is not a tax deductible investment. And so it really comes down to the use of the funds. Awesome. Any other questions? We're good? All right, everyone. Well, I'll wrap up. It was great to see a lot of familiar faces and whatnot. We'll definitely take this away, and if anybody has any questions, let us know, and we'll send out send this out to everybody that attended so that you can view it again if you want to. You can share it with friends, etc., and we can go from there. So thanks so much. Have a great evening, everyone, and looking forward to seeing you again soon. Thanks.